Good day. Welcome to Freeman CPA. Today is April 9th. We're a few days away from the estimated installment due date of April 15th, which is right upon us. Now, the AICPA is currently fighting with the IRS, and I use the term fighting loosely, to try to give us more time. So if you recall, the IRS has extended the due date for filing income taxes for individuals to May 17th. So that was the big deal for us. Now, actually, I'm hearing down the pipeline that we may be looking for another extension of time to file, and it's most likely going to look like June 15th. Let's cross our fingers. This tax year has been extreme with all the tax law changes and the latest developments, so we're not entirely up to speed the way we typically are with the tax season. We appreciate all you guys out there giving us the patience and allowing us to move through the motions as things are evolving. Now, as I mentioned, the IRS is now considering this bill that's being pushed through Senate with the AICPA, where they're looking at giving us more time to make these estimated tax payments. So let's discuss a little bit about the tax system, the estimates, and what that all entails. So yes, the taxes are due with your filing, but it is a pay as you go tax system. Unlike many people usually think that the taxes are due April 15th with the filing, they're actually not. They're due quarterly, and as I said, pay as you go, right? So as you're earning income throughout the year, if this is your income, you're incurring tax liability. Now, typically if you're just working and you're making a W-2 salary, then that amount of, there's taxes being withheld from your wages, either federal or state, and in some cases city as well. So that's why most people don't actually perceive that there is any income taxes due throughout the year, because somebody is taking care of that for them. The withholding, the payroll processing service is taking care of the withholding. But in many circumstances, you'll have income tax liability where nobody's withholding anything. And that would be if you're self-employed. For example, you have investment income. Or other situations that would warrant for you to send in estimated income taxes. So what does the estimated income taxes schedule look like? The schedule looks like this. So 415, and we have 615, we have 915, and 115 of every following year as the quarterly due dates, this being Q1, Q2, Q3, and Q4. So that's the installment due dates every single year, unless it falls on a bank holiday or weekend. You can bet that that's when it's going to be due. So that's basically when your taxes are due. And again, you might have a W-2 and they might be withholding through your regular paycheck, but that might not be enough. You might owe money because they're just under withholding, or perhaps you got married and now there's two W-2 incomes pushing you guys into a different bracket. So if they're withholding 10% here and 10% here, but your combined income for what have you reason ended up to be 22%, you've under withheld by 2%, and that all plays out. So there's definitely situations where you might have a W-2, very straightforward, you've always received the refund, but all of a sudden something changes, a life change happens, and you're under withheld, and then you might owe taxes. Matter of fact, that's the most frequent example of when you might end up under withheld, and people are surprised, well, I never owed money before, I just got married, why am I due with my tax filing? So this is basically our tax system. Now, I have pulled up here the form 2210. It's a little bit lengthy of a form, but it kind of, and it is a 2019 form. So just so you see what this form looks like, all right? This is underpayment of estimated taxes by individuals up on the screen. And it's really complicated. It's not a very straightforward form. And I'm going to go into it from a very simplistic perspective, but just to give you an idea of how estimates are and penalties for underpaying your estimates are figured. So now let's talk a little bit about this form, what options we have as taxpayers to avoid penalties. So as we always like to joke here at the firm, we always say that the IRS has many layers of penalties, just as many as Baskin-Robbins has flavors, all 31. So basically, you have penalties and interest, which may be assessed. And like I said, there's many types of penalties and interest. You have failure to file, failure to pay, right? And then there's interest on top of that. And then there's a whole host of other penalties, but we're not going to go into those because they don't really apply to this conversation. So that's basically the way the IRS works. There's many different types of penalties and interest that goes along with those different types of penalties. But the one that we're going to be discussing today is the underpayment penalty. Underpayment. So what does underpayment mean? It means you haven't made your installments appropriately. All right, so let's discuss what happens if I owe money with my filing and what are penalties like. I'm not going to go into a situation where you didn't have to cover that. We'll assume that you did have to cover for the quarterly, that it's not your first year where you're under withheld. Let's say, for example, something like a business or even a person that every year ends up owing money with their filing because they're under withholding. So I'm not going to go into a situation where there was a refund in the prior year and this year you owe money. And this is just going to basically educate you on what the installments look like and making those installments and basically making sure that you're timely and understanding how the whole system works in terms of your estimated taxes. So now we have what we call the safe harbor, right? So we're assuming that every year you owe with your filing, let's just say $11,000, and you don't want to have this happen. Then what happens? You owe $11,000, then they're going to hit you up with penalties and interest for underpayment. So how do you go about avoiding this? Well, obviously you need to adjust your withholding, right, or send in estimated taxes. The best way to do this would be to basically divide this by the amount of pay dates and then add additional withheld through your employer. All right, that's a very simplistic way of looking at it, but matter of fact, this works the best. So if I have 11,000, and let's say my accountant filed my taxes in April 15th, right? I come out to a bill of $11,000. I'm like, wow, well, I have another 9.5, payments to go, from basically pay slips to receive pay throughout the year. I'm just going to divide this 11,000 by 9.5, go to my payroll processor and adjust my withholdings by $11,000 divided by 9.5. So every paycheck I'm getting, I'm going to receive less because they're going to be sending out more on my behalf through my payroll processor at work. So that's a great way to avoid sending out estimates because those are more complicated and they're like a timestamp. So basically here, if you missed the 4/15 due date and you send in your payments on 4/16, it's counted as if you paid it on 6/15. It's a timestamp. So that's why when you're paying through withholding, that's considered paid ratably over the year. And what does ratably mean? It means evenly over the year. So I can technically pay all my installment. I can send out with my bonus, let's say I receive a large bonus of $30,000, I wish, at the end of the year. I can elect to have all my bonus go to part or a large amount go towards my estimated taxes at the very last day of the year, and that would be considered paid evenly over the year. Evenly. So when it would be broken out here in this calculation of the estimated underpayment penalty, it would be divided by 4. That 11,000 would be divided, and it would be as if you paid a fraction of that 11,000 here, a fraction of that 11,000 here, a fraction of that 11,000 there. Obviously, it's not good cash flow management. It's not the best way to go about it because, again, you should have probably made a higher estimate here. So depending on what your total picture is looking like, it might not suffice. I'm going by a very simplistic example, and that would, all your withholdings were through W-2, you had no other income. That would definitely suffice and it would work. Doesn't always work that way though. All right, so let's talk about the safe harbor. What is the safe harbor? It's basically, it's a method of making your prepayment. So you have, the safe harbor is, you look at your prior year total tax liability, and that's all the way at the bottom of your 1040. Under the new forms, it would be like towards the end where it says total tax. That's the key word. If you're looking at any other line that doesn't say total tax, you're not looking at the right line, because you have, first you have the preliminary tax, then you have additional taxes such as Medicare, self-employment taxes, all sorts of different taxes, and then you get to total tax. So make sure you're looking at the total tax line. That's the key. Once you're looking at the total tax, that's the number we're working with, all right? So let's say now we have the safe harbor. It looks at the smaller of, $100 or 110% of your prior year tax liability. And when I say tax liability, I'm referring to total tax, or 90% of the current year total tax liability. So what's the deal with this? What is the safe harbor? So when I'm trying to figure out how much to prepay in my estimates to avoid underpayment penalties, the IRS gives me two options, and by the way, states and cities work the same way. They say take 100 or 110% of prior year tax liability, or 90% of the current year's tax liability. So this is kind of just, and 110% applies typically to people with 150 of AGI, $150,000 worth of AGI. So this applies to anyone below that. All right, and that seems to be how we cover our taxes. So a lot of people tend to do this installment method. Why? Well, because we don't know what 90% of this year's current year tax liability. Everybody's situation changes, especially when we're dealing with self-employed or out-of-the-box situations, life changes, things like that. It's very difficult to get to the 90% of the current year's tax, because there's just a lot of moving parts and things can change. So if somebody comes to me in June 15 and says, well, I don't know how much to pay, my life situation changed, I'm not earning the same amount of money, I'm either earning more, but I added a business and I have investments, and all these different things happen, and I got slammed with underpayment penalties, I want to avoid that, but I don't want to prepay 110% or 100% of last year's tax, because my picture is going to look very different this year. I want to prepay 90% of this year's tax, whatever that number is. And that's where it's difficult, because the conversation we're going to have between 615 and 915 and then 115 are going to be very different conversations, right? Because things frequently change. So that's what's happened in my experience, is that every time we discuss something with the client between these dates, something's definitely changed. And that could be a bonus, that could be their predictions aren't coming out to what they used to come out to. So these are just kind of like the bumps in the road that we would rather avoid, We want to get our clients a good estimation based on the current year, but it's not going to be very feasible. So we're still going to hedge and try to make this happen one way or another, right? The 100 or the 110% of prior year's tax liability, but we're going to keep in mind 90%. When are we going to not suggest this? When it's in all certainty something's going to happen in the current year, right? Current year, that is dramatically going to bring down the tax liability. So loss of job, moving to an income tax-free state, things of that nature will definitely trigger a very different response from us as far as making this what we call the blind prepayment. And we call this the blind prepayment because we're just simply prepaying last year's taxes in quarterly installments. So if our, if we have 4 quarterly installments in our last year, we owed $100,000 tax liability, we're going to be paying $25K per quarter. And we're going to plop in 25, 25, 25, 25 and meet our safe harbor and avoid any underpayment penalties. So that's basically the safe harbor of making your payments, the installments, when they're due, how we go about making those installments. And again, you can make those through withholding, or you can send them online or through us. There's many options on how to do that. There's paper vouchers that you can use that are typically generated with our tax software. You could, if we're dealing with the IRS as far as installments, you do that through EFTPS. You register with the IRS and you send your money that way. You can also send them through us. We have EFTPS batch provider software, which is used for tax professionals. There's also, if you're dealing with the state, then you can send it through the state portal. They'll take your money through their means, and they have their own way of sending money as well. If we're handling it, we can send it for you. That's typically how those are handled. And again, withholding is one of the best ways because you don't have to worry about sending money out through different means. But again, that's the gist of it. And so you have to just try to monitor what you owe on a quarterly basis. And what you do is you take, 100% or 110% of total year's tax. So let's say we're at the 100% and our total tax liability was 100,000. Once we get to that Q1, Q2, Q3, and Q4, we have to pay in $25K each quarter. And that's, again, federal and state. State would be separate, right? So if this is just federal or the IRS, that's one set of schedule. That's its own schedule. Matter of fact, for 2020, the first quarter was July 15th because they extended that due date for filing as well as estimates. The big distinction for now, 2021, is that we have the filing due 5/17, but the estimates are still due 4/15. We don't know yet. It might be changed as well to 5/17, and then they might decide to give us more time to file, and then also change, if they modify the installments, they might do the same thing again, where they're giving us more time to pay and file. So right now, this is what we're looking at. This is filing, this is paying. That's what we have currently happening. But again, we're not, we're pressed for time, and this year has been like no other. So it puts a lot of strain on the accountants to try to make all this happen because we're just backed up with all the tax law changes. So again, your quarterlies would be due like this, and you'd be sending in your quarterly estimates. Now, this is basically how this form would be populated too. Again, just to make this very clear. When we're looking at tax filing, this form is part of your return. So the way the tax software works is it takes 100,000, it looks at your prior year's total tax, and it breaks it out and it populates this form, and they call it required installments, quarter, 25%, and it would plop in 25, 25, 25, just like this. And then when you get to the end of the year, it tries to figure out exactly how much you've sent in through all means, through withholding, right? Withheld or other, as in estimates. And it compares what you've actually had. So again, if you've withheld 2.5K, or let's say you've withheld 10,000 and you withheld 2.5K because it was withholdings, and remember, withholdings are considered paid ratably over the years, that means you were short 22.5, 22.5, 22.5, and 22.5 each and every quarter, and then they're going to penalize you on being short, because again, withholdings, if you've withheld 10K, that's broken out like this. And remember, it's broken out evenly over the year. So you were short. So what's your estimate then? Right? What should you be, if this is your withholding and you were due 100, what's your estimate? What should you be sending in on every quarterly? 22.5. That's how you're going to meet your safe harbor. 22.5, 22.5. That's what you got to send in every quarter to make your estimates happen and to avoid underpayment penalties, because withholding is considered paid evenly over the years. That's how those work. And that's where people get tripped up a lot, because when the software prints the vouchers, it assumes that your withholding is the same each year. So our software does pre-populate, and I do educate my clients on this, that when like I mentioned, there's many ways to send out payments, and one way is through vouchers. What are vouchers? They're just paper forms that tax software populates, okay? And they're called like the 1040 ES for estimates, right? And the state has its own comparable form. So these vouchers, they just look like a voucher, and they have your tax ID number, they have the amount to send in, they have the address where it's going to your friends at the IRS or the state, right? And tells you which tax year, which quarter, all that information's on this voucher, and it comes right out of our tax software. But the glitch in that system is that it's automated, right? So we just set in our tax software, I sit down, and when I'm preparing my client's return, I just click a button. I say, prepare vouchers for my client based off prior year's tax. So what does the software do? The software looks at what's the total tax from the prior year, all right? And then it says, well, this was the total tax. What was the W-2, 1099 withheld for this client? It asks, and let's say that was $20,000. $80,000 is now what would be due for my installment. That's how the software works, because the software says, well, that's what they had withheld, W-2s and 1099s from last year, 20,000. So this particular client should be sending in $80,000 because they're going to have the same job. They're going to have the same retirement, pension, whatever, withholding the same amounts. So all we really need to do to make $80,000 is send out every quarter, Q1, with these vouchers, Q2, Q3, Q4. How much? 20K. Right? By sending in 20K, because I'm going to assume the same withholding. Right? And that's where people get tripped up, because they don't work here anymore, because they cashed in all their retirement and they added a bunch of new income, and now this tax liability goes up. So that's why it's more customized than one might think. And it's very, so we offer a few layers of protection here at the firm, how to avoid this. And obviously the easiest way for us is just tell our client, hey, prepay 100 or 110% of the prior year tax, and that's what we call the blind prepayment. That's the easiest thing for us to do, but it won't apply to most of our clients, because Like I said, there's life changes, income tax liability goes up, it goes down. So this is our first option, but we have other options, and you know, 2 is more of like already a hybrid, and that deals with a mix of customization and prepayment via blind method. Now, when we get to option 3 and 4, that's already highly customized. That's option 4 is like a la carte. We're sitting down, we're doing a tax projection. We're looking at things much closer and basically tallying up your installments throughout the year. We're having multiple meetings. These are situations that are complicated. There could be a transaction that's going to take place. Who knows what? Many moving parts. Just telling somebody to prepay 100, 110% is not going to cut it, because they're going to owe a lot of money with their taxes, or actually overpay a great amount. So that's when we're retained for something way more customized, and we're actually using tax projection software that our regular software provider has as an add-on. And we're getting variables and inputs from our clients, basically saying, well, I'm going to sell this house, it was a rental, I'm going to sell it at so much, and we look at what the cost was, and if it was inherited, what is the fair value, if not, what, you know, basically putting together a what if scenario and building out basically a future tax return. We're building out a tax return way ahead of time, with future rates and future tax laws and everything that apply, trying to do the best that we can to come in as close as possible to this person's accurate tax liability. So when we're dealing with something like this, if we, you know, that's like with something with so many moving parts, if we come out plus minus anywhere from 8 to 10K, we did a great job, because there was just so many moving parts that there's no way we would hit it on the mark. You know, a very simple, straightforward tax plan, plus minus 3K to 5K. We hit it on the mark. That's a very simplistic situation. Maybe there's a marriage, a couple of kids that changed, increase in income, bonus at the end of the year. This is still awesome tax planning. All right. This is awesome tax planning with many moving parts. When you're getting a bill for $40,000, folks, and yes, that's the scale. For some people, that might be very good tax planning as well, because they have a tremendous amount of tax liability. So $40,000 is a drop in the bucket for them. They cut a check $40,000, they don't even blink. We have those here too. But it's all variable. It's all codependent on your situation and what you have going on. So don't take this as the all and all be all. Take it with a grain of salt. All right, folks, so that's my presentation on estimates, and hope you found this to be useful. If you have any questions, you know where to reach us. Again, these things change. This is only current as of today, April 8th, 9th of 2021. Let's see what happens with this tax season, these installments, these filing due dates. They're always keeping us guessing, but that's what we're here to do, is to take all the guesswork out for you guys. All right, Freeman CPA signing off. Again, our motto here is your success means our success, all day, every day. Thank you, and have a great day.